Is Zim stock a dividend trap or it's worth it? At first, I was a bit skeptical. I mean, with a dividend yield of over 100%, it's easy to think this is too good to be true. But when I dig deeper into the company's financials and fundamentals, I was blown away. Zim is a global shipping company that specializes in container shipping. The company was founded in 1945 and has since grown to become a major player in the shipping industry, with a fleet of more than 100 vessels that transport goods all over the world. The company's focus on innovation has helped it remain competitive and adapt to the changing demands of the market. Overall, Zim is a well-established and forward-thinking company that has shown impressive growth. When I first came across Zim stock, I was immediately drawn to its high dividend yield, which at the time was over 100%. However, I was hesitant to invest because such a high yield often indicates a dividend trap, a situation where a company pays out a high dividend to attract investors but may not have the financial strength to sustain it over the long term. But sometimes you need to risk a little bit, so I decided to buy it. If I must be honest, I decided to buy one share and just reinvest the dividends and see what will happen. But after I bought it and received the first dividend, I decided to take a closer look at its financials and fundamentals. I found that the company had a positive earnings trend and a PE ratio of just 0.5, which means that the company's market capitalization was smaller than its annual earnings, indicating that it was deeply undervalued. The dividend is well covered from the earnings, and the company have a PE ratio of just 44%. In addition to this, Zim have a very strong balance sheet. Its debt to asset ratio is 0.5 and have a lot of free cash flow. But there are two significant factors that may affect the company's future revenue. The first one is the potential impact of OPEC reducing oil supply. This could have a negative effect on the global economy, leading to reduced customer spending and demand for the shipping industry, and it will result in higher transportation costs for the shipping companies like Zim. And the second one, the price for container shipping has decreased significantly. In April last year, it was $8,000, but currently it is around $1,700. The company has a dividend policy of paying out a portion of its revenue as dividends. Given the current market conditions and potential impact on revenue, it's more likely that Zim will reduce its dividend in the future. But based on my research, I decided that Zim stock was a good fit for my portfolio. Even if the company's earnings were to drop by 50%, it would still be worth investing in it, because this will represent a dividend yield of over 10% based on the current price. So in conclusion, I decided to buy some more shares. Yes, I think the stock price will fall shortly after lowering the dividend, but with time, when things go back to normal, Zim will be one profitable, stable company, rewarding its shareholders with massive dividends. So that's my take on Zim stock and its dividend potential. If you found this video helpful, like and subscribe for more related content. Thanks for watching and see you in the next one. Bye bye.